All right, we're live. We're down a Brad, a Kron, and a Tom, but we're up a Jason, so it's still a good day. It's always good, especially in this market when you can be up on anything. So hey, we'll take it. Well, we got some stuff to talk about with Alibaba. Some mixed results in their last earnings with some interesting things to highlight. Hint, definitely take a look at cloud, not growing as much as people might have hoped, but top line stuff not looking too bad. But anyways, we'll take a look in further detail in a moment. And we'll talk about plenty of other things too. But before we get into that, as always, be sure to like, comment, subscribe. It goes a long way towards helping the channel out. And check out our discount links that we have down in the description below for Seeking Alpha and for ShareSite. You can get a free account with both of them, but if you want to get a discount on their premium versions, definitely make sure to use our link so you can get a discount. So with that said, let's dive into it. I do have to highlight this one question here from James. It's the very first question. We normally don't dive into questions that quickly, but great question from James. What would I rather have happen? A rear naked choke from Jason or an arm bar from Frank? We were talking a little bit before the show about this, and Jason brought up the fact that Frank's arm bar is world class. So, that's a high risk venture going in there. There might be a chance of escape from Jason. So I'd probably have to just respect Frank and say I'll take a shot with Jason, and we'll see what happens. I think Jason would concur with that opinion.
Yeah, 100%. I would. I think that's the smart move. And
he's dangerous.
Frank is dangerous, and I think he trains. So those guys that train, they're just waiting. Make my day. They're just waiting to use it, and when they finally get a chance, they'll just rip that thing out of socket. So
I'm getting a lot of credit I don't deserve here, but I appreciate it.
Good stuff. All right. Where do we want to start?
Into the serious stuff.
And I think he's a little angry too, Jack. You don't want him to armbar you today because he's a little angry because his cloud business did not do as well as he was expecting in Alibaba.
Not even close.
Guess not. Here I can pull up their recent earnings release. It's not updated on ticker, unfortunately, so I can't make it look super pretty. But they do all right with their charts and their reports. But here's for the June quarter, the last 3 months prior to the end of June.
Can you zoom in a little bit?
Yes. Paying close attention to year-over-year change. Is that good?
Oh, wow. So that customer management, to me, that's always the one that I look at because I think that's how they make a lot of their money with Taobao and Tmall. The really profitable stuff, as I understand it, and a huge chunk of their business, and I guess 40%, and that's down 10%. So last quarter, I think it was down like 3% year over year. So that is what's standing out to me, and the other one is the cloud, just growing 10% stands out.
Yeah, because this was definitely pitched as or has been and is still pitched as like kind of one of the big growth engines for Baba, not necessarily retail, which is already comparatively mature, and it's also lower margin. So there's a lot to be desired if it's only 10% on the year. I know there's like some like regulatory or like data privacy concerns that the regime has sort of instituted that might be a source of kind of some of this slowing. I'm not too sure on that though. I've only kind of recently been reading up on that. Is that something to keep an eye on here? I guess it's sort of always a caveat with Baba, given their size.
I think that's part of the problem with investing in China is there is probably some justification to poor results all around, even though it beat some of the expectations. Obviously, a non-growth of revenue, cloud only growing 10%, it seems concerning. But there's all of these things happening in China right now that are leading to a slower economy overall, lockdowns and everything else happening.
Right.
But how much that actually plays a part in this, I don't know. Maybe if that happened in Australia, I could make a better judgment call on that. But it's hard to know in China what is reasonable or not.
And there is always a substantial macro concern with China, just again given their size, especially you could say they're pretty dependent on the growth of China in general, but then you're getting into that slippery slope of trying to predict macro events, which just gets very difficult because so many things can change outcomes pretty wildly if you're trying to predict that. So, but it certainly cause for concern if you're seeing a decline for whatever reason in the overall economy, and what that could mean for something like Baba that's really dependent on future growth, or at least seemingly dependent, if you're trying to get those outsized returns.
Yeah, I mean, it's not a good quarter, but when I've been in Alibaba, I'm not right now, but every time I've been in it, I've tried to avoid the mistake of looking at just one quarter. When I was kind of getting a little bit negative on them, they had a rough quarter, and I judged it, and then I realized, like, okay, that was kind of dumb to just focus in on one quarter and assume because they stopped growing in one quarter, they're going to stop growing, and to kind of I'm almost preparing myself if the price drops to maybe get back into it if it really drops a lot. But they have a lot of things going for them. They have a lot of net cash. They have that Ant financial stake, which is worth what it's going to be worth. And then I guess you could argue this could be the worst quarter they'll ever have again because this 3-month period in China was like, it was almost like March of 2020 in the United States. It was just really shut down. And they even said that on their earnings call. They said something to the extent of like, we're basically at the mercy of the lockdowns and we don't know when they're coming around again. And we'll just do the best with what we can. So thinking about it long term, this was a really bad quarter and it might be their worst. But on the other hand, the thing I always worry about that with them is competition. I don't hear that nasty word brought up with Tencent ever, but I hear it brought up with Alibaba a lot. And that's always something that's worried me is the competition that they have to deal with.
Seems like it'd be hard to compete on. It'd definitely be hard to compete with them on e-commerce, just retail, because they're already kind of that low margin provider of sorts. It seems like it'd be pretty hard to break in, just given their scale and their ability to keep costs down on a per unit basis. But for some of these growth engines, I think, especially cloud computing, there's a lot of competition there, major competition. That would be much more cause for concern, I would think, if you're betting on big growth. So yeah, that's definitely a point.
Well, just like TikTok is just making life really hard right now for Meta, the sister company in China, Duo or whatever it's called. I think they do a lot more e-commerce than TikTok does, is my impression. And the Tmall and Taobao stuff, my understanding of it is they make their money from advertising. And so if people's eyeballs are going off of those things more and off of whatever their live streaming business is and just getting sucked up by the TikTok sister company, it's concerning me. And then when I see that revenue, customer management is down 10%, it's just a concern. So at this point in time, I really don't have any interest to get involved with them again because I have a big Prosus stake with Tencent. And I just have concerns with the direction of their business and how much of it is competition, how much of it is a one-off really bad quarter because of the macro events. I don't have a way of telling because it kind of ends up in the same result, which is the numbers are down. So I'm kind of in a wait and see mode and pounce if the price really, really drops again. Because a few months ago, it was trading for almost like a PE of 5 if you backed out the cash. So, and a little something for Ant Financial.
Yeah, it's been hovering largely hovering. I use that word lightly, but it's been hovering around 90, but kind of going up as high as maybe 120, down to below 90 as well. So it's been kind of bouncing around there a lot for quite some time now. And to kind of like the macro concerns, if that's our friend Karan, I know, has done this move, and rather than just holding Baba, he's moved a lot of his money into KWeb, the sort of ETF that tracks a lot of the larger Chinese tech companies. Is that a move that either of you guys are considering. I personally haven't at this time, but it is compelling if you're not, if you're a little bit worried perhaps about individual company risk and would rather just take kind of a basket approach. And then you're still exposed to macro risks, of course, but ideally you are less exposed to any one company getting shellacked by the regime or something like that, or whatever risk you might not be too comfortable with. Is that a move either of you guys are considering?
Definitely not one that I would consider personally. For an investor that's trying to be more defensive, like it makes sense to kind of diversify. And overall, the whole market of China, particularly their tech stocks, are cheap right now. But it's not the way I personally would like to go about it. I'd like to dive in and find out what are the best companies within KWeb, and that's where I'd put my money. And I guess that's what I've done to an extent. But yeah, I can see why people do it at least.
And on my side, I don't know of a way to buy KWeb for a 36% discount to the net assets of KWeb like I've done with Prosus. So that's why I've stuck to Prosus. And when it comes to China, I'm very focused on the business, Tencent and Prosus, and they happen to be in China, and that's probably why they happen to be cheap right now. One of the reasons. But as far as like just I'm going to invest in China because China's down right now, I don't invest like that either, and I don't have that. I don't have knowledge of like what else is in KWeb, and even when I hear those names, I kind of know some of them, like the business they're in, but I don't know hardly anything else about them. And for me, I'm a shameless cloner, so I also don't have other than cloning Quran, which I would definitely love to do. I don't have any super investors that are in KWeb, so that's why I've stuck to Prosus.
Fair enough.
And I guess just a bit on the commentary about the state of the market and business operations for Alibaba specifically. If we can trust Daniel Zhang's word, which that's up to you to make your mind if he's telling the truth or not. But he did say that April and May were two of the worst months for Alibaba, but they started to see some recovery in June, which is right at the end of that quarter. And he expects improvements in July and even more so going forward. That was kind of the commentary he put around for their numbers. So I think moving forward, we could see some better results, but
and the free cash flow was up pretty significantly as well. So, that's definitely a positive, especially given what you just said, Frank, and that they definitely had some rough months just given the circumstances, yet still came out pretty decently. Like, yeah, there's lots to be desired, but it's not as though they, halved or something across the board or something catastrophic.
Yeah, I think we're being pessimistic, but it's beating analyst expectations. So that's why we've seen the share price go up. It was priced in to be worse than this. So even though it's pretty much break-even revenue growth, slower cloud growth than you would like to see, earnings are down, everything. It looks bad other than maybe that free cash flow that might look like a savior, but it's all market beating the expectations of analysts. So it's not as bad as it might look if you weren't following the company, I guess.
Yeah. Is it just me or I haven't been hearing like the delisting talk very much anymore. Maybe that's
just
me,
you.
Yeah,
it popped up again recently with the
it's in the last few days.
I guess very recently. Yeah. But
it calmed down. It's a yearly cycle, it seems. They just drop it in there once every now and then, and
maybe every quarter around earnings season.
And it's almost they're talking about doing a primary or a co-primary listing or something like that in Hong Kong to diversify off the New York Stock Exchange or outside of it a little bit. And I was hearing today that could be upward pressure on the stock price at some point because it would make it easier for the millions and millions of investors in mainland China to be able to buy into Alibaba. It would make it much easier for them, which pushes the stock price up potentially. On the other side of things, though, if you Google SoftBank and Alibaba, there's been some articles in recent days because I think SoftBank had like maybe an earnings call or an announcement or something, and they've done some kind of contract where they've done like a forward sale on a very large chunk of their remaining Alibaba stake, where basically they've sold it, but they haven't sold it yet. but it's someone else's, and then they have the option to buy it back at a certain point in time. And if they don't, then they effectively have sold it. And apparently that's going to put downward price pressure on the stock because there's going to be a big stake out there that's selling. And then I read something about the two of the founders. They're allowed to sell at some point here soon or something with some of their shares. So there could be a lot of downward pressure on the stock price. There may not be, but there could be. And then you add all the macro stuff in that's going on. It's like there could be a lot of pressure on it. And I'm kind of just sitting on the sidelines waiting. So
there are two things I actually really wanted to touch on today in this. So the Hong Kong primary listing is expected to add about 21 to 22 billion of inflows to the company. So assuming that's correct I know that's trusting endless again, I suppose. But there is extra money that should be moving towards Alibaba as that goes ahead. But the SoftBank stuff is really interesting because those options that they sold, it's effectively selling, or the way it affects the share price is selling because they put those options off to the banks, and the banks short the stock kind of as a hedge. So it effectively looks like they've sold it, even though they have the option to buy it back at any time, which whether or not they decide to do that is a bit hard to know. But over this past year or so, the value of that stake effectively has went from about 160 billion down to 50 or 60. Those numbers are off the top of my head. I'd have to fact check that, but it's a bit more than half down from what it really was worth. So the share price movement over the past year or so is dramatically been affected by that. And assuming they buy them back, we should see a reversal of that. If they don't, then we should stop seeing that downward pressure that's kind of been happening. So that SoftBank stuff is pretty big news for Alibaba, I think, for sure.
Yeah, very, very impactful. And it just goes to show there's a lot of reasons why stock prices go up or down that don't necessarily have to do with the results of the business at any point in time. And that can lead to a lot of it advantageous opportunities.
The markets are efficient, Jason.
Well,
they're highly efficient, not erratic.
If I got a tenure and a big check, I'd say the same thing. So
everyone.
I don't know is anyone saying that I mean, is that like we've heard Buffett and Munger go after or make fun of those guys for decades, but like sometimes I'm so plugged into the punch card circle, the value investors, that you realize just how small we are, like how small percent of the market we are. And
the internet is all small echo chambers, some bigger than others.
Yeah. And I guess a lot of people still think that.
No, yeah, it's there. Certainly like the index fund movement has really, really pushed that. Maybe not so much that the markets are like perfectly efficient, but certainly that like it's impossible to win by stock picking, and not to say that it's likely to win by stock picking, because the data definitely shows that's not the case. I think that kind of school is really taken over. Certainly academically, and even in law school, we talked about it for a moment in my securities law class. Yet to the efficient market point, one easy counter is that, okay, if the markets are efficient, why are there so many different S&P 500 index funds that all trade at slightly different prices and all have massively different expense ratios if they're all doing the same thing? How do you explain that discrepancy if things are truly efficient? That's a very simple one. But
I think a fair take on it I heard was that they're like very efficient most of the time, So I kind of agreed with that.
I could get behind that.
Yeah.
Or maybe if you want to, I don't want to say bend it, but you could say that people are factoring in emotions, and that's technically like factoring in information. And everyone understands that, like that you could make that argument, but it's at that point, it's not like it's all logical. I guess the question is it logical to factor in other people's emotions, which I guess it is if you know it's going to be a thing that's going to happen. So, but anyways, before we start talking in circles, I think the point is there is a pretty substantial population in academia that kind of throws out the efficient market type stuff, and certainly the index fund type stuff as doctrine, Not to say that it's a bad idea, but they definitely stand by it.
So funny with Alibaba. They went public in 2014, September. So we're almost coming up on maybe 6 years, and 8 years. And they went public or ended that day at like 93.89 or something, and today they're at 92.56. So is that cheap? I don't know.
It's always frustrating comparing to IPO price, because like typically you're only IPOing because you think you're getting a good deal on your share price as a company.
Yeah.
So whether or not it was in a bubble when it IPO'd is the question, which certainly some recent companies benefited from that.
Well, I think it's safe to say that the forward growth expectations for Alibaba are significantly lower than they were during the listing time. So it's only fair to apply a lower multiple to
why is that, Frank? Is that because they've already grown, or is it a competition thing, do you think?
Mostly, I think just because of the size they've reached, like particularly for the e-commerce, which is the majority of the business. There's not much room left for that to grow. If they tried to expand, I know it's a little bit outside China now with some of their e-commerce, but the international stuff can only grow so much as well. Within China, they pretty much at a plateau, I guess. As the kind of the economy improves and people have more disposable income, I guess they can grow slightly that way. But as a user basis, they're pretty much at a plateau. So I think most of that growth is from people spending more as their economy improves. But
yeah,
you can't grow revenues at 50% per year forever.
Yeah, I think if you're going back to these early, like 2014 or whatever, the growth expectations were huge. There was a long way to go, and it was semi-easy to see that at the time, I guess, which that's a hindsight bias, I guess. But yeah, it's a lot different now.
I've got the revenue growth on ticker. This is from 10 years, last 10 years. And looking at the rates, 2012 to 2013 was 72% revenue growth. You can't be doing that for too long before you.
So they maintained that kind of growth.
They did maintain amazing revenue growth for a long time, and really still it's quite high, all things considered, but just not this ludicrous level.
And then I guess if the cloud plays out the way people would hope,
we have
there's a chance for that growth to pick up a little bit, but still it's small relative to the overall business. So
I don't want to call it it wouldn't be like I don't want to say flash in the pan, but something kind of like that, where it's like an extra sort of jolt in the growth rate, but definitely not forever, because nothing is forever when it comes to growth.
I guess at a bare minimum, you get that e-commerce to grow roughly with GDP, theoretically above, but then you have these underlying businesses, mostly the cloud business, that could bump that up a little bit, but it's nothing like the expectations that you would have had in the early 2000s, 2010s, I guess.
And that's one reason I'm biased towards Tencent over Alibaba, is because Tencent has the video game business, and of course that has a global reach, and Alibaba just doesn't have the ability to do that with e-commerce. But Frank, and to you, Jack, are you either of you guys in Alibaba or still in Alibaba?
I still am.
Yeah,
and
I still have
the quarters like this, or the current just macro environment, does it make you get itchy to sell that and do something else with it, or are you kind of like not looking to do anything for like a decade kind of move?
See, when I went into Baba regarding the macro stuff, I was already uneasy about it, so that really hasn't changed for me. It's pretty much just, it comes with the territory. At least that's how I see it. Investing in China, you are investing with the regime, and the regime is a risk. It's just kind of a live wire, and there's not a whole lot you can do about it. So that really hasn't changed, and we see what they do, and we know they do some crazy stuff sometimes, oftentimes even. So I just kind of factored that in, and that's a big reason it's not like half my portfolio or something. It's a limited portion, and I haven't been looking to add much because of that.
Yeah,
I've kind of got my max comfortable level. Go ahead.
I kind of sit pretty similar to Jack there, where it was expected to Going into the investment, you knew it was going to be rough. It was the macro environment was always tough, but I think if you zoom out a little bit and take more of a long-term approach, there is some argument to make that there's a bullish trend, even though over the past year or so that's certainly not been the case. But overall, China's economy has been improving for a while now and should continue to do so. But they are in a bit of a slump, so there's both sides to that argument, I think.
They got a bit of a debt bubble to worry about, but we'll see what happens there. But that's a lot of, that's not just China. Also, there's debt problems everywhere, but theirs is especially bad, like with real estate, for example. And what kind of trickle effects that has, we shall see. But it'll have some effect. But again, came with the territory.
And I should clarify that I'm zooming out. I'm talking 10, 20, 30 years.
Right.
I'm not thinking anywhere in the near term.
There will be ups and downs regardless. So, that's to be expected with any investment ever.
There's just a big part of China that's still an emerging market. Overall, a lot of it has kind of that growth taken place, and there's been big improvements, but there's still a lot of people, hundreds of millions of people that are still in a emerging market. So that's potential growth towards a company like Alibaba, if that improves over the long term. So I tried to ignore that for the most part, though. I don't want to make my investment based on any of these macro situations. I think the bet is on the fundamentals of a business. But Alibaba makes you think about these things more than a usual investment, I guess.
Yeah. What about you, Jason? Do you care much about that? Obviously, we're all kind of fundamental people first, but how much do you factor in kind of that sort of macro regime side of things?
I think the only thing I can do is, like, I've made my investment in Process, so obviously, just like you guys, I'm okay with it up to a certain extent. And I think the only thing I can do is just control my position sizing. And so that's why I went 30% in the Process, maybe too much. No. I guess that's
swing for sure.
Yeah, that's all I think. I'm a little lower than that, but like, that's all I can do is just, not go too much, because I was thinking the other day, like, what if China does like a naval blockade around Taiwan and just like does it, and then like, I was trying to think what would happen with like Process's investor relations, or China's so much more interconnected to the West than Russia's economy, and it was hard to play out like what would happen. So I really don't know. But I can tell you, I'm just not comfortable having more than a certain extent of my money in a Chinese-based company, and what that number is, it just depends. But it's definitely can't have a lot of it in there.
And Russia's pretty connected to the West, just in different ways. I wouldn't say that it's significantly different. Certainly with manufactured goods, way more. But Russia has tons of natural resources.
More so on the the stuff that kind of matters more than anything, the commodities and gas and heating your home and all that in Europe. But I was just thinking about, like, we like Apple, for example, like 25% of their revenue comes from China, and a bunch of their supply chain goes through China. So like, I don't think they would be giving out statements like, we're shutting down our business in China because they did a naval blockade. Like, they can't.
Fair.
So it's hard to know, what would happen,
which
kind of leads me to think like probably nothing will happen because we're so interdependent.
Probably, yeah. But it's that, the 5% chance that something bad happens, or whatever percent chance it is. And that's, you just have to be as prepared as possible. That's where some diversification helps. Obviously being in a financially solvent position would help. And having multiple income streams and all that. So if an investment doesn't pan out, you just shrug it off and try again.
One other thing to think about, though, because Matt's mentioning Apple, Starbucks, Nike, so many big companies have so much business in China. If you do take a huge bet, like I have on a Chinese company through Tencent, through Process, maybe you need to think about the rest of your portfolio. And even if it's a quote unquote non-Chinese company, like an Apple, like a Starbucks, like a Nike, you have to ask yourself, well, if that 5% thing does happen and some of this Cold War stuff turns hot and there's this real separation of the economies, it's going to affect your big swing investment in China, but it's also could affect these other companies that maybe you weren't thinking that way about them. So I've never actually thought about that before. So I need to kind of consider that.
Yeah, I think maybe the way to look at that would be for what would the next substitute be for some of these companies that are connected to China? Maybe not entirely reliant. Like, yes, they're using a lot of Chinese resources now, and maybe they do have a significant portion of their sales there. But what would happen if that was just shut off? Could they survive? In many cases, I would think yes, but in some cases, no. I think that might be the question. Kind of what's the next move? Like, do you move manufacturing somewhere else? Is that easy to do? Is that super difficult to do? I think that might be the question. But that is a good thing to think about, in that there are a lot of companies tied to China, even though they're not Chinese companies per se.
Yeah, and like massively tied to China. Like a lot of
Yeah.
GM's business, I think, is in China. And then you have companies that really aren't, like Fiat, Stellantis. They don't really have hardly any business in China. Google has no business in China. Facebook, Meta has no business over there. So there's plenty of huge, big, good companies that don't. So you definitely have your option if you're worried about that.
Yeah, I think this comes down to, I guess, probabilities, and then ties back again to position sizing. So with any investment you make, there's a probability of an absolute zero. You could have the extreme example of a meteor could hit the USA. I don't know, something ridiculous. There's always
Australia
probability, or Australia.
Yeah.
Take it so easy. Any investment could be a zero, and it's obviously when you move into China, these high unlikely events are more probable. Whether that's the CCP doing some outrageous regulation or something that would hurt a company or destroy a company completely is much higher than the USA. So you have to factor that into position sizing. Or if you're thinking of some kind of foreign invasion like this Taiwan situation, arguably not more likely than the USA because they do that to other places, but it doesn't affect the USA. So,
whoa.
let's be honest.
It hurts so bad. It hurts so bad when it's true, Jack. It just hurts so bad. You know, it's like he's got a good point. It's like, damn, man. It's like
with the USA, it doesn't have an impact.
It wasn't always like that, and we'll bounce back. But you're right.
It doesn't have an impact on their companies, whereas it would for these Chinese companies. So you have to factor that into position sizing, but the probability is still low. It's just higher than in the USA.
You know what's really difficult, Frank? I don't know what the Chinese Australian politics are right now, but my sense is that there's a little bit of stress there, but it's nowhere near, I don't think, like the USA and China. And Jack, maybe you can speak to this, but like Frank, it is so difficult for me right now to picture a world where China and the USA are like China, or are like the USA and Brazil, or the USA and India, where it's like, no, we're not like true allies, but like we get along and there's no talk of like Cold War all the time and all this drama. We're so in it right now. It's hard to see us all getting to that place 10 or 20 years out, which maybe it does. But Jack, do you kind of feel that way? Like it's hard to see a world where we don't have this political strife with China and the threats on both sides and all that?
Well, it's kind of weird because there is some dependency both ways, in that the U.S. is a giant customer for China, but then China keeps buying a bunch of U.S. debt, which is a risk for them, because if the U.S. just keeps, printing tons of money and the dollar gets worth less over the long term. Right now it's gotten stronger, but there is some interdependency which calms things somewhat. But then meanwhile, you're playing all these kind of side games. And I think that's just the natural course of having two essentially superpowers, at least economically speaking. Whoever's in second or third place is always going to be gunning for first place. And right now, the U.S. seems, if we zoom way out over the last 50 years, the U.S. seems to be in a world relative decline, whereas China's definitely been on a rise. So is there like a turning point at some point? And yeah, it is hard to picture, but I think that's just kind of the natural course of global economic domination, politics, all that stuff. There's always jockeying for position. It's definitely made different when both sides have nuclear weapons, but
we're officially beyond my pay grade right now.
What's that?
We're officially out of my pay grade right now. I cannot make comments on this stuff. This is where it's way out of my circle of competence. So it's
I'm really speaking. I'm speaking very generally. I'm not making any prediction, but just looking at history, the stuff like this happens. The setting is different, but like the general trend happens a lot. And yeah, to this comment
Someone's
here,
bringing up, yeah,
I,
Ray Dalio. I was going
I
to say
can't
the
I
same
can't read
thing.
those characters, but Ray Dalio has some good work on like the changing world order. If you haven't seen that video or read his books, pretty good stuff on it. Just as like a real nice, easy to understand way explaining kind of leading powers and global reserve currencies and all that good stuff. Just a decent to understand. It's a pretty good argument that he makes.
And Lewis says all this China stuff is stressful. If it is stressful, then just don't get involved. And sometimes I wonder that myself. Like, what
That's
if
crossed
this
my mind.
25-30% of my portfolio was not in Process and it was in Google, more in Google or Carvana or whatever. I definitely want to have to think about all this stuff, but I think there's kind of no right answer because there's great investors on both sides of this argument. Some of them don't want anything to do with it, and some of them are making very bold investments there. I think the first kind of macro event I'm looking at that will affect investing is this 2024 delisting threats from the SEC. I'm kind of like sick of hearing about it. I'm just really interested to see, like, is that actually going to happen? And I guess we're down to 2 years at this point, so we'll have to be looking out for that.
I think it'll just always be like a leverage point. I'd be impressed if barring some massive escalation, if there'd really be some delistings like that, without some sort of like catalyst event, maybe an invasion of X country. But it seems like it'll just always kind of be a threat. But then, you don't want to use the threat and then you lose the leverage. It's kind of that weird sort of thing.
Well, it's a hard square to circle for me because, like they
Yeah.
say, you have to let our auditors in. They have to look at this stuff, and then China saying, no, we're not going to let them look at that stuff. And I don't know what kind of agreement they could come to, but will be quite interesting if that happens.
Yeah.
I think time frame's important for that too. It doesn't happen overnight. It's a long process, and I think you would see a lot of capital just shift towards this primary listing in Hong Kong or the existing Hong Kong shares. So
Yeah.
it's not a zero case for Alibaba. It's just
Well,
a short-term
one would think.
problem. Yeah, and of course it would hurt. It would be a dramatic downturn in the share price.
We saw
Something like that happen.
We saw some extreme stuff with Russia, like capital seizures and capital flights. So it can get pretty extreme very quickly, and you could be locked out potentially. And
I think just to touch on what kind of Lewis was getting at there with the speculation in China being stressful and all of that stuff, I think this is why opportunities exist. This is why there's inefficiencies. There are other reasons, but when a lot of people are stressed, I guess, like you said, or are scared to invest in an area, that's why we get cheap valuations. So I think Howard Marks made a comment on that recently that I've seen pop up on Twitter, talking about China in particular. So I'll be curious whether he moves any money towards China. But he kind of just said that this is why opportunities exist, and that's how he's made money throughout his career, is investing where people aren't willing to invest. And China's definitely that at the moment, and that doesn't always work out. That's why, again, fall back to position sizing when you're making any consideration towards these investments, I guess.
Yeah. Eunice is bringing us back down to earth. Maybe a quick note on
Eunice. There's nothing to talk about with Baba. It's a boring situation at this point. Guys, check me if I'm wrong, but it's essentially they've got a dominant e-commerce business, but it's flat to shrinking because they've got competition and they've already grown, and they've got net cash, so you have some nice protection in there with the net cash. And then if the cloud business takes off, you're going to have a great investment. And if it doesn't, you're probably going to have a mediocre run. And will that cloud business take off? I don't know. Is that a good summary, or am I missing something else with that investment?
I think you're pretty much spot on. There's nothing's changed in the past year other than the share price. The business is doing exactly what you would expect. And then I guess cloud is the only maybe underlying thing where I'm like, hopefully that grows faster. But
there's been some kind of like ancillary things like Ant Financial that's been kind of awkward, but again smaller compared to the big juggernaut is e-commerce.
But that's boring too, in the sense like it sucks now. Like when I first got into Alibaba, one of the biggest reasons why was because they had this 1/3 stake in this beautiful financial technology company that was like growing and had so many people using their product, and then the government said, well, you're not going to use it like this anymore, and they had to sell off the most profitable parts of that business, is my understanding.
Luis says, remember when Matt Damon said, "Fortune favors the brave." So, thank you.
It wasn't just Matt Damon. There were a lot of very, very rich, powerful investors pumping up that asset class that
still are.
I'm too scared to talk about.
Still are.
Yeah.
Not as much, but still are.
Yeah.
Oh boy.
I was rewatching the 2022 Buffett and Munger Berkshire annual meeting where Tom was in the audience, and I listened to that Bitcoin thing again where Buffett went on and he was like, if I could buy all the farmland in the United States for 25 billion, I would do it. If I could buy, or 1% of all the farmland for 25 billion, I'd do it. If I could buy 1% of all the apartments in the United States for 25 billion, I'd do it. And if you want to give me all the Bitcoin in the world for $25, I wouldn't do it. And I just, it was so funny. Loved hearing that.
just to ruffle the feathers. People, I can't even imagine how pissed off some people got.
Yeah.
When you identify with your investment, you have to be very careful. Which I've seen a lot of that over the last few years. Just people, and it's not just in crypto, but stocks or anything. If you're personally offended by a critique of like a financial asset, that you really need to check yourself and check your investment as well, because you're probably not making even close to a rational decision. Not
By the way,
not that it's easy to do, but yeah.
I have no idea how you do individual dollar and cents amounts like Lewis did with his super chat, $5.84. I've been trying that with some very particular numbers that make everyone smile, but I haven't been able to pull it off. Jack, there's a good comment by Ju. See what I mean? It makes everyone smile. Ju Yun Chang. And this is one of my big worries about Alibaba and to some extent Tencent, but I have way more confidence in them to pull this off.
Right here?
Yeah, China's smaller businesses, government agencies have their own cloud because the cost of building cloud centers in Western China is extremely cheap. I was not aware of the cost issue, and that's interesting, and I'll have to look into that, but I was aware of the different dynamic that Chinese businesses feel about the cloud than American businesses feel. And in America, and I think Europe, it's been a lot of like, oh, you can do that for me easier and cheaper. Yeah, here's all my data. But I've read things that say in China, businesses are more skeptical of handing stuff over and putting stuff off site. And so this whole idea that there's going to be 2 or 3 huge cloud dominant companies and they're going to have a huge revenue and all that, I'm skeptical of that, because I don't know if cloud's going to develop the same way in China that it's developed here in the West. So that concerns me as well. Another reason I'm not in Alibaba.
The cloud market is very different for a range of different reasons. So it's unfair to make comparisons to the US, even though I do it myself, just in the sense I like to do the Alibaba Amazon comparison with their cloud just being the market leaders. But beyond that, they're very, very different businesses and very different markets. So you can't make these comparisons. With the smaller business stuff, I think Jason
can you
said
speak to that at all, Frank?
Well, it's just more infrastructure based, but no, I don't understand it well enough to speak on it much more than that. But it is just a different market overall as well. So beyond just being a different type of business, it's a different market as well. So it's not going to look the same as it did in the US.
And just like their e-commerce, they jumped right into e-commerce and phones before they jumped into credit cards, is my understanding. And that's why fintech stuff took off so much there, because they didn't have that intermediate step of credit cards. So yeah, it's probably going to develop a lot different. And Ju Yun Chang says exactly, in the US, the market has already been dominated by AWS before businesses realize the importance of its data. So interesting, yeah.
I think with these Chinese businesses not wanting to give these bigger companies their data, I don't think that's completely true, because they're all very dependent on both Tencent and Alibaba just to operate. So I kind of find that argument a little bit difficult, but I don't know. That's the cheapness of cloud, I guess, is a relatively good point, but I think that changes with scale, and you'll see some consolidation within that market, I'm sure. But again, it's hard to make comparisons, so maybe I'm wrong.
Should we move on to to Carvana for a bit. I know, Jason, you wanted to mention it. They're up quite large today, which has to have you feeling good if you weren't looking to buy anytime soon.
Jack, I don't know what's wrong with me or what kind of week I had or something, but I didn't feel that good today. And maybe it's because this investment I'm looking at more for like a 30 to 100 bagger, but a 40% rise, it's almost like this is supposed to happen. And I'm missing out on my chance to buy even more. So I do want to take a bit of a victory lap, but at the same time, it was essentially, oh, you didn't go bankrupt last quarter market rally.
That's
And
kind of what it's all about, though. I
yeah,
mean,
which
like
I didn't
we were
think they
talking about that
would.
before.
So I was right in that sense. But yeah, I think we've got a long way to go. And it'll be really fun to see where it takes us. But I guess the main thing I'm trying to do today is just trying to stay balanced and to realize that, like, if I really do think this is a 30 plus bagger, I need to be in the mindset of buying, and I need to fight that anchor tendency, the anchor bias or whatever it is. So I'm trying to do that, I guess.
Could you take us through a little bit what happened with the recent earnings, just like a summary and kind of what
they said we didn't go bankrupt, and then it popped. So the earnings came out Thursday afternoon after the close, and initially I was a bit worried because it looked rough. Like the one piece of really good news was that revenue and units went up again, and that had not happened the previous quarter. The first quarter was like horrible, and sales actually went down for the first time. So revenue goes back up, and there's actual growth year over year and stuff like that. So that was good, but like there was a huge loss on the quarter, and I was a little bit worried that there was going to be a huge negative reaction. So funny, like with all things Carvana, between the time the earnings came out and they finished their earnings call, all the chatter online, it just like everything with Carvana, no one knows what's going on. Like some people thought they missed the earnings expectations, and then like a lot of people thought they beat. And it's like that's not even something that should be debatable. It should be very black and white. But with Carvana, it was. And like, was it a good quarter, bad quarter? It was all up in the air. But then the earnings call was really, really good. They're trying to tighten up the fixed costs, selling, general, and administrative, and they're growing again, and they're kind of getting back on track. And that's pretty much what the quarter was, just kind of getting back on track. And for the first time in the history of their business, instead of optimizing for growth, optimizing for cost and hopefully soon cash flow and that sort of thing. And then it was up like 10% after hours. And then the next day, I was surprised today how much it was up 40%.
Yeah, financials wouldn't be on ticker yet, but it's interesting that happened because like I know, just being in Illinois still, they were banned from selling from Illinois again for a variety of title related issues. So I would have thought, just like without really following closely, that would have been a bad.
I know,
quarter.
but Jack, well, like, what does that have to do with their business?
Huh?
What does that have to do with their business?
Well, they can't make sales in Illinois. They're like,
I'm messing with you.
Okay.
Yeah, that's kind of important. Yeah.
Okay,
no, so I mean, even that we were able to spin around to a positive, where a judge came out and said, no, they can still sell while you guys are working this out. And on the earnings call, they mentioned how they rallied us evangelical supporters, customers of Carvana, and they basically put the word out like, people, big fans of us in Illinois, we're trying to save you time and money. Contact your regulator and tell them to let us sell you their car. And they got like 6,000 people to sign something or tweet something or whatever. Yeah. Yep. All around the country, because the march continues. And
that didn't result in anything yet, right?
A judge came out and said, and he ordered an injunction or whatever it's called, where he said, well, you and the state are working this out, you are now allowed to sell cars again.
I thought that was before. You mean they've done that again? Another injunction?
Again, yeah. No, like within the last week, they've been.
Okay.
So
I didn't
just
that.
Like 10 days ago or whatever, the news came out, we couldn't sell cars there. And then like 3 days ago, the judge came out and said, no, you can during this time period.
It's almost an exact repeat of what happened before. You had to order against, then
it does kind of, it bothers me where they the way they talk about this. Like if I was running that company, I would be like, whoever's responsibility this is, I would say this has to stop, because
Yeah,
even if
really.
it has to stop, because every time this gets out in the news and people write articles, it makes the next person less likely to buy from Carvana.
Of
And
course.
even if it's not a big problem, and what they say on the earnings call is like, no, actually, us compared to other dealers, we actually do this better. This just gets blown out of proportion. And my answer to that is like, even if that's true, it
Yeah.
has to be
Right.
stopped. And
Right.
but to be fair to them, it's not just them. Like they're dealing with what they call their partners, the state governments in every state, and obviously those aren't the most up to speed.
Accommodative.
Yeah, people to work with sometimes, or whatever to work with. So they're dealing with that. And I can tell you, I just bought a car from a dealership recently, and we're 15 days in, and we're still trying to get the title worked out, because they didn't put my wife's name on it. They put my name, and we've got to mail stuff back and forth. And the tag agency said, no, we have to have an affidavit. So it's a messy thing regardless, but
Yeah.
it definitely doesn't sound like it's a real problem, but it's perception is reality when it's such a big branding thing, and they've got to stop
Yeah.
letting that get out there. So,
All right. We'll see.
yeah.
It's a bit of a live wire, I would think, but that's an interesting way to frame it, though. And anything else
And
on
I like,
Carvana to note?
Matt's question. He said, does the
Mhm.
quarter's numbers make you want to buy more?
That's a good
Uh,
question.
and so, yeah, independent of what happened with the price today, and who knows what it'll do next week, but yeah, it does make me want to buy more, because they got back to growing. And I am a believer that they can control those selling, general, and administrative cost, and get their fixed cost down over time while they continue to grow and then get to profitability. I'm a believer in the master stroke move they made, buying the Adesa. I hope I'm saying that right, but there's a
The
auction
auction.
company. Yeah,
Yeah.
they bought in all those 56 physical locations. They're already putting Carvana cars there. Like I think that's a wonderful move. And the thing is, what I loved on the earnings call is Ernie Garcia, the third, said it something to the effect of like, it's almost like we can see the growth now, because in markets they've been in the longest, like Atlanta, their market share is up to like 4 or 5%. And they've been able to see that market share go up over time and still continue to grow. And they're in plenty of markets where they're more recently in there, where they're at like 1 to 2%. And they know if they just follow the system, that 1 or 2% in all those newer markets will get to 4 or 5% where they are in their more mature markets, which are still growing. And it's almost like we can see that growth, because they are taking market share and they do have the capacity. And one final bullish thing on them, the used car market is in a horrible recession right now. And it's basically where it was in 2008. It dropped down like 15% in the second quarter, year over year. I believe that's units. Carvana's units were up like 13%. So the overall market was down 15%. They were up 13%. And that's like means they're taking market share. And then I sold a car to them recently. So I'm loving the Carvana situation.
This I'm looking at this is per quarter free cash flow, cash from
Oh,
operations and
crap.
capital expenditures.
No, I'm kidding.
Yeah, this was unexpected for me. At least this quickly, especially given the environment, like you're saying, with used car prices in a bit of trouble, it seems.
Yeah, I'm
So
surprised that number is actually positive there. I don't like, with cash flow statements, it always kind of depends on the industry, because I know like
yeah,
it just depends on the industry, like in the accounting, and they definitely didn't generate cash. That's for sure.
yeah, it's still negative,
Yeah.
even on like a free cash flow basis. But yeah, I'm not sure the exact way they're calculating it, but regardless, it was deeply negative before, but not so much now.
Can you just go down a little bit again, Jack, to that cash flow statement?
Yep.
The huge change there, the plus 466 million change in inventories. Do you know anything about that, Jason? Because that's really why they're positive, I guess, just looking through that quickly.
I don't know. And they were even, I think, on the call saying something about inventory being down or something. So again, with like, it just depends how these numbers are being pulled in. But I can't really speak to that at all. But I can tell you the way I think about the accounting with Carvana is basically they focus on their gross profit per unit, and that mixes in what they make each time they sell a car to retail, each time they sell a car to wholesale, and then what they make from the loans when they sell those loans, and that all gets into a gross profit per unit. They're profitable there. They need to get more profitable than they were last quarter, and then you get your overall gross profit, and then below that is your fixed cost, selling, general, and administrative. And the more units they sell, the more they pile on that gross profit on top of that fixed cost. That's when they're going to start to show that profit and that operational leverage, kind of like Amazon did at some point. That's the plan. And so that's how I kind of think about their accounting.
I think the whole Carvana situation is interesting in the sense that the upside is huge and the downside is huge. It's like a good chance of an absolute zero. This debt could become a real problem.
Yep.
And there's a time frame to that. I think I read on a Twitter thread, so could be wrong, but I think they said they had 4 or 5 quarters until that would become an extreme blow up and they would have problems. But if they're starting to turn over that number and produce cash, which how accurate that is, I don't know, then maybe that becomes less of the problem, and that's why we see this 40% share price increase. But yeah, it's not the type of bet I would make, but it is appealing in the sense that the upside is so big. But the downside
I'll tell you,
is also
in some of their bigger markets, they have like 4 or 5%, or some of their more mature markets, 4 or 5% of the used car market is my understanding. And the used car market is 40 million cars a year. Now, I don't know when they say 4%, if that's all the used cars or if that's only the used cars age 1 to 10, which is what they do business in, which is more like 25 million a year. But let's say it's the 40 million. If that 4 or 5% goes to 10% market share one day, just 10% of the used car markets. And right now, CarMax has been doing it for a very long time. They're at like, I think 2 or 4%, something like that, maybe 4%. But let's say Carvana does get to 10%. That is 4 million cars a year, and that this margin of like the gross profit per unit, they want that to be, I think, $4,000, and they're selling general and administrative. Maybe that I forget what it is, but I think they want to make like $1,000 per car profit. So like 1,000 times 4 million cars, that's like $4 billion of profit. And that's kind of how I'm thinking about it. And then $4 billion of profit times a PE of 20, that's like an $80 billion market cap. I bought it for 5 or 6 billion. So that's kind of like the way I've seen people think about the bullish situations. Like they get the market share up, and then we make 1,000 or 1,200 or 1,500 or 1,800 profit per car, pre-tax, whatever it ends up being, and then take that times 20. And that's how people are thinking about the potential market cap. And people aren't just thinking about 10%, by the way. They're thinking more of an e-commerce landscape where, and I don't know if Frank has the sniffles or if he was laughing at that comment, but some people are talking that it could get to be 25, 40, 30 something percent.
That would be pretty wild.
I think 10% is a stretch, and I think even if they can do that, like maybe 10% is achievable, but I think the time frame is so far out that market cap you're suggesting could be so far away that it doesn't mean your returns on investment are as great as it could be. And now this is not a business I study or know well, so that could be completely wrong. But I just don't see the shift in a market that's existed for so long.
Matt says fortune favors the brave. Well played.
It did today. I see a super chat by Nishant.
Yes, I've been meaning to pull up Nishant's props. Jason downplaying the.
No, but I mean, I see these things about false humility and all that. Honestly, like it was just another day. Like it didn't hit me. So
he's got his eyes on the 100 bag.
I expected it.
If you're not looking to sell anytime soon, then it is just another day.
But I will say, how do they go from that 5% in Atlanta, 4 or 5% in their more mature markets, which by the way, they're still growing in, and that number's still going up. How do they get to 10%? And then how does 10% get to a third of the used car market? I saw Cliff Sosin on YouTube a couple of years ago. He was talking about Carvana, and he was talking about, imagine a world 10 or 15 years from now where you ask your friend what they're doing this weekend, and they go, oh, well, we're going to go shop around for used cars. And then he was walking through the hypothetical, and it was like, what kind of world does that make sense where you have to go to these dealerships, you have to go there, you have to spend your time. They have a limited number of inventory. They cost more than buying the car online through Carvana. And then with Carvana, you can get the car delivered to your house. You have a 7-day, no questions asked return policy, and it's cheaper. And it saves you all that time. It's like, why would people ever go buy used cars in person again after this is a thing that picks up? Now, some people will, but I think more and more people won't. And one final bullish thing on the quarter, speaking of other used car dealerships, other used car dealerships let people co-sign for loans, and that makes cars more affordable for more people and lowers interest rates and lowers the down payment requirement and all that. Carvana has never done that. They've always required the person buying the car to be the one that is signing the loan. In South Carolina, they are rolling out co-signers for the first time, and that's going to probably help sales, and then they're going to roll that to more markets. So there's still a lot of levers that they can pull for growth, just beyond being a better service. And one final thing is they can also become a platform at some point. They do have a service where other used car dealers sell inventory through Carvana that Carvana approves, kind of like Amazon third-party sellers, and they take a fee. That's not a big deal right now because inventory is so tight and used car dealers are able to sell what they have there in person. But if there's ever a glut in that market, that could be another driver of growth as well. And maybe that 10% or 30% market share goes to 50%, Frank.
Last question before we kind of wrap up, but isn't a huge portion of their revenue financing, or at least I should maybe not
Yeah,
revenue,
it
but
is.
profits is financing. It's
A
not
huge,
actually
yeah,
car
a
sales.
huge portion of it. And so these are really, really rough numbers, like probably inaccurate. But when I'm thinking about a $4,000 gross profit per unit per vehicle on average, I'm thinking about like making $1,000 to $1,500 for a retail unit, $500 to $800 for a wholesale unit, and then like $2,500 to $3,000 of that average gross profit per unit comes from selling the loans. Now those numbers may be off, but yeah, my recollection is that, or those numbers are off, but yeah, a big chunk of it comes from selling the loans. Which there's nothing wrong with that. I hear people talk online about selling loans is like a bad thing, but the more I
No,
read
like
about
that,
it, I was like,
dealers
this is a
do
real
that.
thing.
Like that's a
Yeah.
common dealer move. I just wonder if credit, if that market of people, of banks or whatever buying
Mhm.
car loans shrinks, that's a huge portion of their profits.
Well, and then this is a bet sizing and position sizing issue because
Yeah.
I went like 30% into Google, and I sleep extremely well at night because they've got $140 billion of cash, $14 billion of debt. Google can make $0 of revenue and lay off 0 people and fund their operation for 3 years with how much cash they have. So it's like, I don't worry about a wipeout at all there. But I was listening to Guy Spears' book recently, and he talked about, at the end of his book, he talked about his investment in CarMax in 2008, or he was thinking about investing in them, and then the credit markets seized up, and apparently CarMax was at a real risk of going out of business because the credit market seized up on them, and there were no buyers for those loans. And because Carvana is in that industry, and it's very sensitive to macro, I do realize that I could have a wipeout here, both for the position Carvana is in today, but also because the nature of their business. So that's why I kind of limited things at a 10% bet.
Fair enough.
Yeah.
Cool.
And I should clarify too regarding, like, I'm just joking with Jason mostly. I don't think 10% is impossible for him to reach that. I don't doubt that. I actually like the idea of the business and think it could be a great business. It's more so a time frame issue for me, both on the debt end and how long it takes them to kind of penetrate these markets. Do you know how long it took them to get the 4 or 5% in Atlanta? Out of curiosity, how long?
Well, it was their first market, and so I forget when they started doing business, but it was somewhere around 2014, maybe a little earlier. So we're looking at, I think, 8 to 10 years. A lot of people don't think they can do that. Like a lot of people don't think they're going to get to those 10% and higher numbers. Um, but I do because I'm telling you, I've just seen these charts that show the growth in markets. And by the way, one of the things that put me over the top to invest in them recently is they had all this horrible quarter, and people were wondering, kind of like we were with Alibaba, is it a macro thing and they're actually getting better, or is it they are having problems? And I decided it was a macro used car thing, and Carvana was actually doing better and better because I was seeing, like, I saw the recent 1 year, year-over-year growth in some of the markets that are huge for them that they've been in for a long time. And in those markets, they're still growing like 20, 30, 40% per year. Um, I think based on units it was. So um, why that would stop happening and why they would not in Atlanta get from 5% to 7% and 7 to 10% when they offer such a fundamentally better service and product than used car dealers, the retro ones. I don't see why it would stop happening. And it's almost like their growth is limited right now because they have to deal with these cash flow issues and their current capacity.
I think part of the growth will slow down because this is a business that is the growth is funded through debt, and with debt costing more, the cost of capital is higher. It's harder to spend as much to grow as much, and that customer acquisition cost is high. Maybe that lowers over time. I don't know. Maybe it becomes more of a word of mouth thing, and people just start doing this. That's a bit unknowable in my mind. So I think the growth slows down, and I think even things like regulations, like you're seeing in Illinois or wherever it was, that's probably going to happen over time too. So that's why I mean by time frame is if it takes, say, 8 to 10 years to get 4 or 5% of a market and then replicate that in 50 states, with regulations becoming an issue, debt becoming more expensive, and really not knowing what the unit economics are in a business, I think there's a lot of unknowables. And then you
But
have this debt time frame and cash burn too. So
yeah, and just to tell you how they're thinking about it, you look at the earnings release and that sort of thing. They're talking about. I want to pull it up. I believe we're talking about significant positive EBITDA in 2023, and in 2021, I think for the year they finally got the positive EBITDA, and the reason why is because they make money every time they sell a car. They have a gross profit per unit that's like significant, and the whole name of the game here is these fixed costs that are currently giving us a loss. And can we just do one of two things? Can we sell enough cars to cover that fixed cost and make a real profit, or can we tighten up that fixed cost to where we can make a profit now and be sustainable and not worry about the debt markets, and then let the growth take care of itself as more and more people use us? That's more what they're going for now. And one of the things people point to as to why that is potentially the case is because in the pandemic they significantly seized things up and they like significantly shrunk their cost and were still able to run. And so that's the hope now, is that they're able to do that. And I'm just gonna pull this up. I'll let you guys know if I can find it, but I know they're looking to significant positive EBITDA in 2023, I think.
It would be weird if they said negative.
Well, so here it is. Finally, we continue to expect a return to $4,000 total gross profit per unit and a significant positive EBITDA in fiscal year 2023. And so if they get there, it's like, we don't need the debt markets because we're producing cash. So
just to push back on that a little bit, the gross profit per unit is less appealing to me because that customer acquisition cost moving down a line is the concerning part. Of course, that GP per unit matters as well, but I think the earnings you get out of that is what matters the most, just because I think it will cost a lot to acquire these customers. And maybe I'm wrong there.
Well, I look at their earnings release, and they've got this thing called long-term financial goals, and they basically break out their gross margin, which last quarter was 10%, and they want to get to 15 to 19%. And in 2021, they did get to 15% gross profit per unit, gross margin. And then below that is the advertising line item, and that is they break that out separate than the selling, general, administrative that I'm talking about. But right now, like in last quarter, it was only 3.4% of their revenue, and their long-term goal is only 1 to 1.5%. And you can see over time what they've done with that advertising cost. It was 7% of revenues in 2016, and it's just gone down every year and come down to 3.4%. So like, if you're worried about the numbers, like they're worried about it as well. And they definitely have a model to get to profitability. It's just a matter of doing it. But they're thinking the same way.
Yeah, and I guess that's where I again go back to these how much the capital costs. Like they have to pay interest on these debts, and that's going to be high moving forward. I think the appeal and why Carvana was priced so high was almost entirely on a low interest rate environment, because this business model works in a low interest rate environment. So I think that's why the macro call matters here. What is this debt going to cost Carvana over the long term? Whether or not they survive the short term is another question, but I think
Frank, I mean, I'm of the opinion that we're never going back to ask for more debt. And if we do, I'm in big trouble. That's my outlook as I look at this investment. It's kind of like we're there. We had positive EBITDA in 2021. It's just this freaking quarter, the first quarter of 2022, it was insane how bad a quarter it was. And like we had the Omicron in the United States during that time period. And like there were points and times where 30% of their workforce had called out sick because of Omicron. And it's like you try to think about running a business like this and delivering cars on time and all that when 30% of your staff is out. It was just like a horrible quarter. But yeah, I'm of the opinion that we're not going to have to go back to the debt markets. And that leads to the question of moat. And one of the things I think they have going for them is that this time period, this really weird time period that was really good for people like Jack Duffley, where they could get all this real estate at cheap interest rates, the low interest rate environment, that's not going to happen again for the foreseeable future. And so can another competitor come along and say, hey, we're just going to lose money for a decade and grow our market share and grow our brand? Probably not, because it already happened, and it's too hard to replicate that environment when interest rates are like they are now. So I kind of think it can be a moat enhancer, if you will, to go back that they were able to do this in the good old days of 0% interest rates.
Unless you
and I know, Jack, I know you want to get there. I know you want to get there. You're like very close to being a Carvana customer. I know you want to put this into the portfolio. Yeah,
I'm close, though I'm hesitant. I don't know how the problem, if they've had problems in Texas, but
well, I know they definitely have to try them out. You have a 7-day return period, no questions asked on the car. I know you're doing some moving around, and it's hard to move vehicles, so I'd encourage you to try us out. Carvana.com. Get a quote within 30 seconds.
I have been looking, not as aggressively, because I've been spending a lot of time on Amazon and HomeDepot.com just buying stuff. I've been pumping those share prices up as much as I can.
Jack, the whole YouTuber thing is happening to you because as your life gets more complicated, I hope not, but maybe a little more stressful as you're dealing with all this. I see the videos. You're out there in the Houston heat. There's no air conditioning in the house. You're making the video. I'm worried about you. You're sweating. All the wallpaper's falling off the wall. As your life becomes more of that going on, your content is getting really, really interesting and good. So as a fan, the drama is interesting, and we want to see you make it to the other side with the rehabbed Houston house.
I've got all the before footage that we're making good progress. So there will be a good. I think I got enough. I got a good start on my B-roll for a nice rehab before and after type video.
I'm just paying you a compliment. The content's great, and all the footage you do. I watched the one where you did the day in the life, and I was shocked how high up in the sky you work. In Chicago.
It is pretty wild, but I appreciate that. So stay tuned for the Houston stuff. I haven't been to the Houston office. Maybe they have good sky views, but no way it's that high. That's one thing that's hard to replicate. So it's cool. Anyways,
super chat.
Another from Nishant. Super chat. Can Room be the second player in this, Jason, or I guess competition in general?
I don't think Vroom.
They're having some
I don't
serious
think.
trouble, right?
Yeah, I don't think it's going to be Vroom. I think Vroom is.
CarMax is the problem, right? Not a problem, but that's the bigger competitor, I think, in a different way.
So you've got CarMax out there, and the whole thing about competition is like there's probably going to be other people doing this. There already are, but we're at 4%. I think we're at 2% market share, and then we're trying to. In some markets, we're at 4%, and we're going to grow. Carvana can get to 10 or 15% or 20% market share, and another online player can get to 10 or 15% as well, and they can both exist. But when it comes to competition, I'm looking at CarMax, but I'm not really worried about them. There's just something about them where this is not in their DNA, and they're so tied in some respects to the model, to the in-person model, that they just don't seem to be interested in pursuing this to the extent that Carvana is, because maybe they're comfortable making the money they're making now. There are two large public car dealerships, Lithium Motors and Ashbury Automotive. Both of them have their own fully online brands that they're trying to grow as well. And they're named different things. They're not named Ashbury or Lithia, but they come from those companies. They're going for it. But they don't. One of them just looks like I'm not worried about it at all. It looks really, really bad. The other one looks solid. But it doesn't look as good as Carvana, and I would not be surprised if someone else rolls out and gets to a significant market share. But I don't think it's going to be a thing where there's going to be like 7 other players like streaming right now, and it's like brutally competitive. So those are my thoughts on that.
Yeah, I think there's room for competitors. The shift towards buying used cars is going to generally, I would say, trend to this online direction. So it doesn't have to all go towards Carvana for them to be successful. I don't think
it seems like the competitors are just local dealers, not so much like a national.
Yeah, the main problem is local dealers keeping that market share too.
But they're not. But they're not the problem, because the local dealers still have a parking lot with 40 to 200 cars on them, and they don't have the car you want with the mileage you want, and they're not. Maybe they do deliver to your house, maybe they don't, but it's still limited inventory. Compared to Carvana.
I guess CarMax, again, having multiple dealerships and all that thing is more so of what I meant by that. But regardless, it's what the customer is going to do. Do they want to go and look at the cars in the dealership as they always have? Is that a model that's hard to break through? Can they keep that market share, or will Carvana take it? Which I think generally Carvana would take some, assuming that they survive. Just how quick that happens, I guess.
Fair enough.
Yeah.
Shall we wrap up?
The Carvana talk can only go so long before people start to hate you for whatever reason. So I feel like I'm in a good spot where everyone's still okay with me.
No, that was good. We talked about some risks. We talked about some good news, and that's all.
We covered the two most controversial stocks in the market right now. So
that was a good. Yeah, we covered a decent amount of stuff there. I think that was pretty good. Maybe the people will disagree, but I feel good about myself.
I'll shut up here, but I just have to say this: you guys have the smartest audience on the internet with value investing, and your audience, and then you guys truly, Jack, Frank, the other guys, we love this show. I'm speaking for the fans now, and it's such an honor to come on here. I look forward to it so much, and I just appreciate that you guys let me in your world to the extent you do, and I love coming on here. So thank you.
We love having you, Jason. It's great to have kind of a liaison between
he's fishing
the
right
people,
now. He's fishing.
The masses that we need to tend to, and you got the stuff to come onto the show and carry a conversation. So it's always great.
Appreciate it. Yeah.
We like it.
Big shoes to fill. But I'm happy to do it anytime. You guys have my number.
And how about some claps in the chat for Jason? We thank him. Some thank yous in the chat. And speaking of which, we got our punch card conference fund coming. Should I just go ahead and commit to we're going to try to do something maybe around Berkshire time next year? Maybe.
Look, Jack, I'm being honest here. Like, there's this whole magic with Berkshire Hathaway in the annual meeting. Look what that did for all of their careers. Look what it did for the people involved. I think it would be so cool if just once a year.
I think
It's not.
so
It's not
too.
a money thing. It's just a thing, you know. And then you
No,
can
right?
have
Yeah, to
people
meet
pitching
up.
stocks. Yeah, it's
Yeah,
so cool, you know, and such a worldwide audience that I'd love it. So I'm pushing it.
yeah. I think that would be pretty cool. And it would be probably easiest to maneuver because of all of our different locations, and it'd be a nice excuse to kind of get everyone together in a place where we'd all want to go anyways, in our weird value space. So with that said, thanks again, Jason. Nice talking with you as well, Frank, as always. Like, comment, subscribe if you haven't already. Check out the fabulous links in the description below. Join the Discord if you want to join this community of super smart, intelligent, interesting value investors with many different perspectives on many different stocks. So join the Discord there, get some good stuff in there, ask questions, get to know some other people who might have similar or different perspectives on whatever stock it is or whatever it is besides stocks. So please go do that. And yeah, until next time.